Welcome back. You're putting the spotlight on the money markets now. The Reserve Bank of India has unveiled a fresh set of liquidity measures. It has announced a 2 lakh crore rupee additional OMO bond purchases and a $10 billion USD INR foreign exchange swap line. We have with us Lakshmi Iyer, Group President, Investments and CEO at Bajaj Alternate Investment Management, and Dhawal Dalal, President and CIO, Fixed Income at Edelweiss AMC. Ladies and gentlemen, thank you so much for joining in. Season's greetings to both of you. So it seems that the news headlines are not abating, even though holiday season is setting in. Let's get your sense, because, I mean, while in the policy, the RBI did indicate, but I think in the policy, Lakshmi, they announced OMOs worth about 1 lakh crore. Yesterday, what we got is 2 lakh crores, and it's coming in bam, bam, bam. I mean, throughout, January. Is it because the market was getting tight? There's been a lot of talk about how there's a lot of supply, there's a lot of, state debt that's being sold in the market. Your first thoughts?
Yeah, hi, good morning, Surabhi. So definitely the bond markets were actually behaving like Ranveer Singh in Durandar. They were they actually behaved
rising
like
and rising, yeah?
No, they were actually living the moment ghayal hu, isliye ghatak hu. So I think,
Wow.
they were wounded and therefore they were behaving lethal. And enter Santa Claus, or should I say Mr. Sanjay Claus, where it just opens up the bag and hydrates the bond markets, which was so much needed. Because two parts to it. To your question, the bond markets were rising relentlessly in terms of yields because there was an inherent demand and supply mismatch. Point number one. Point number two is even the durable liquidity in the system was getting a little bit challenging. And given that the CRR as a tool has already been invoked, there needed to be another primary infuser of liquidity, which is the OMO and the swap. And of course, it does have the intent of cooling off the yields, which almost, I would say, flirted with 6.7 levels as of yesterday. And then we saw cooling off. So I think it is much intended, cooling off required in an era of climate change. This is a much welcome move.
Some mood today. There's Durandar, there's Sanjay Claus, and then there's climate change cooling off. Let's see whether Dhawal also, resonates with that sentiment as well. Dhawal, with the kind of cool off that we've seen, a slight one, where do you see these levels settle and, maybe move from here on?
So obviously, Lakshmi's legendary comparison notwithstanding, I think the bond market has been a little soggy, if I may use the word. And it's like probably the probable uncle who's unhappy with the wedding. RBI pumping so much of liquidity in the last month. I think the bond yields continue to trend higher, presumably because the Reserve Bank of India did not announce any OMO for the January. And I think also the higher than expected SDL auction, I think that was these are the two triggers which pushed the bond yields higher in the first in Monday and Tuesday as well. So I think in response to that, the Reserve Bank of India has come out with a very big bazooka OMO bond purchase and a $10 billion swap. I believe that this should calm down some of the nerves in the bond market who has been asking for more and more. And I think this is a very, very good level of injection. I think from 1.5 trillion to additional 3 trillion. This should be sufficient, in my view, from the bond market's perspective to stabilize the bond yields and bring them lower to a fair value. I think in the last couple of months, we have seen the yield curve experiencing a little bit of bear flattening, where the short-term yields have trended higher, particularly 5 to 7 year segment has been the biggest hit, and while the long-term yields have actually trended lower. So I think some amount of respite is needed at the short end.
Sure. Both of you are on a roll, right?
Someone told me on the 24th at 9:50 you'd be discussing bonds, and suddenly someone spoke about Durandar, Uncle at the wedding, Santa Claus, and Ghatak, Ghayal.
So
those things, I
think it's very, very colorful. Maybe I can add on. It's rubbing off on me as well. So that uncle, we'll call him Uncle Scrooge, Dhawal. So that's how the bond market was behaving, not getting into Christmas festive spirit. But then Sanjay Claus stepped in. I must apologize at the outset.
Grinch.
In case anyone from the RBI is watching, this isn't just, this isn't jest, it's holiday spirit. So please excuse us.
I think we should change it to Grinch, right? Because it's the Christmas season. So that is the really grouchy person.
But, just to complete that point, and, I leave it to either of you to take it up. So a couple of factors which were leading to these higher yields, right? The higher supply, the SDL auctions, like you mentioned. I want to understand to what extent was this unprecedented rupee fall and whatever little the RBI was doing to support. It wasn't doing much, but some sales were happening in the market. Did that also exacerbate the position? And during that time, there was some chatter about whether FPIs will start selling in the debt market as well. They're anyway selling in equity. So there was some fear around that. So where are we on the whole rupee front and the rupee bond tango then? Lakshmi, you want to take that?
Yeah, so Surabhi, if you look at the month of December, the FPIs have actually net sold even in fixed income. Up until now, they've sold about 12,500 crores. Of course, for the entire year, we'll be closing in closer to about 56,000 odd crores, 1,000 crores positive. The rupee depreciation and the resultant intervention also exaggerated the liquidity deficit in the system. So as of this early start of the week, we were in a marginal deficit. And I think that's where the governor has played true to what he mentioned in the policy, that they will ensure that the liquidity in the system is not hampered. And with this announcement of the swap, INR swap, we are coming back into the region of plus minus that 1% of NDTL or net demand and time liabilities. Is it that the rupee depreciation is leading to a spike in yields? That's not clearly the establishment, but of course liquidity was definitely a challenge, and I think that has got addressed to.
Okay. Lakshmi, what would be the impact on the 10-year bond yield? Where does it settle, assuming there are no more shocks or surprises that come in, based on this announcement? And then even, say, over the next 3 months, FY26, the end of fiscal year 26?
Rima, our view is clear that this is a good and a very positive move, much intended to bring some cooling off on the yields. You could see yields receding towards the 6.5% region, but incrementally, will banks continue to support? See, they've been tendering in OMOs. Have they been really buying in auctions? I think all of that will set the narrative for it to decisively breach the 6.5 level on the lower side and stay there. So I think there are going to be multiple and our view is that this may not be the last of the measures. So I think bond yields are going to be in check, maybe closer to 6.45, 6.5 lower end, higher end of 6.65. I think the lid for the bond yields have been done for now, unless some other bazooka unfolds.
All right.
More measures are expected, according to Lakshmi, to keep the yields in check.
Let's see whether that happens or not. Dhawal, just a word on the correlation between the way the rupee weakened and the impact of the bond on that. Now we've seen the dollar weakness obviously come by over the last few sessions. So that's stabilized the rupee a little bit. Where does that go from here?
So our analysis shows that there is a correlation through the cash term rates. And what we have observed that during the swap days, first swap of $5 billion, we saw the cash term rates moving all the way up to 7.5 to 9% in some days. And as a result of that, we saw banks taking advantage of the higher cash term rates and try to issue bank CDs in a higher quantum in month of December. And that has resulted in a slightly higher short-term rates. We also saw some redemptions in the system that all has contributed to some amount of selling from mutual funds in GSEC as well as in corporate bond market, and that has pushed rates higher at the short end. So these are the confluence of factors which has resulted in some amount of higher yield in corporate bond and GSEC. And now in January, Feb, March quarter, we have to see how much of the SDL supply comes in, because that's the one last bridge to cross as far as bond market is concerned. If SDL supply is lower than feared, then I'm sure that the 10-year will clearly go below 6.5.
having,
Finally.
by the way, a positive rub-off on many of the NBFCs. So if
NBFC is doing very well.
Very well. If you look at the top two Nifty gainers, it's Bajaj Finance and Shriram Finance. And outside of that, you've got a Manappuram Finance, of course, aided by the record surge in gold prices, but an M&M Financial also up and about, L&T Finance, Poonawalla, Sammaan Capital, Edelweiss Financial. Across the board, I think that is a sector which is leading today, and it's aided by the moves and the announcements seen by in the bond market by the RBI.
Absolutely. Who says there was no green in the Indian equity market? Just look at what happened to these financials and particularly in some of these NBFC stocks. What a move on them this year, and it's continuing as we wind up the year as well. Final question to both of you. So the other issue for the market, will the RBI cut or not cut? Are we done with rate cuts? Where do you stand on that? Outlook 2026, Lakshmi?
I'd say that the incremental scope of significant easing from here is not there. So we would probably push our luck and max maybe see one more rate cut. But beyond that looks very, very difficult. And timing, I don't think it's a slam dunk that we'll see it in Feb.
All right.
And Dhawal, quick 10 seconds, your call.
See, our view is that inflation is likely to surprise us on a lower side. So the RBI will have a room to cut, but whether they cut or not, it's immaterial. I think the 10-year will clearly go below 6/4 in 2026.
All right, gentlemen, take that call. As we speak, we're speaking about the festive season. A couple of stocks that, deserve mention. Sula has been, again, a rank underperformer. Sula has been down, 45% this year. A big cut from its post-IPO price as well. Currently seeing a gain of almost 7.5%, maybe the season of mulled wine this time. But the other one is VIP, as sources